Just a few months ago, we were still talking about Bitcoin's all-time high around the $126,000, when the atmosphere on forums felt like a true festival excitement optimism and a strong belief that this cycle would be different. But looking at the present, at the beginning of 2026, the market has completely changed color to a deep red. Bitcoin has evaporated roughly 50% of its value, no small figure. And even names regarded as symbols of long-term conviction like Michael Saylor are facing very large losses, at least on paper, followed by the event on February 6, 2026, when the People's Bank of China, PBOC, together with 7 other government agencies, unexpectedly issued a joint announcement tightening comprehensive controls over stablecoins and the tokenization of real-world assets. However, the most frightening thing does not lie in that decline itself, but in the core question, why is this time different? This does not resemble a random crash, nor does it carry the look of the emotionally driven panics that have repeated in the past. This time, it feels as if something is operating behind the scenes, an invisible force, a machine quietly at work, and that feeling is entirely accurate. We are witnessing a systemic event rather than merely an emotional reaction of the market. Recent analyses indicate that Bitcoin is trapped in what can be called a structural trap. Imagine Bitcoin as a 3-legged chair. Normally, if just one leg weakens, the chair can still stand. But this time, all 3 legs are wobbling simultaneously, the holding incentive, the mechanics of capital flows, and Bitcoin's foundational narrative. When all 3 of these pillars weaken together, collapse is no longer a surprise, but simply an inevitable consequence. Starting with the first leg of the chair, the holding incentive previously, the reason to hold Bitcoin was very clear: digital gold, an inflation hedge, a safe haven, an escape from the traditional financial system. But in the current context, those arguments are gradually losing weight. Looking at the macro picture, interest rates remain high, and monetary policy continues to tighten, especially as markets are being shaken by the news that Kevin Warsh has been elected as the new chair of the Fed. The emergence of Warsh, someone long known for his tendency to defend the strength of the US dollar, has created a wave of expectations for an era of a powerful greenback. With a mindset that prioritizes the stability of the USD, as a national security instrument, his election immediately generated a massive pull that pushed global capital flows back toward traditional assets. And at that point, the question becomes very simple: why hold a highly volatile asset like Bitcoin when safer assets are entering an attractive and clearly defined yield cycle under the new leadership of the Fed? It is precisely at this point that the holding incentive begins to weaken, not because belief disappears, but because the context has shifted in a way that favors the strongest fiat currency in the world. Instead of having to sit and pray for some long-term scenario, a large fund manager today can do something far simpler: buy U.S. government bonds and receive yields of around 6% per year, almost risk-free. And it is right here that the problem begins to emerge. The opportunity cost of holding Bitcoin suddenly becomes extremely expensive, and this is the critical point for financial institutions, those managing billions of dollars and whose performance is measured quarterly. Their question has completely changed. It is no longer, is Bitcoin the future, but why should we hold it right now? Especially when the market offers safer, more easily justifiable options that still deliver very good returns. In the world of large funds, a story about a distant future simply cannot overcome the pressure of current quarter performance. Of course, fervent Bitcoin advocates will immediately push back, arguing that this is the mindset of traditional finance, that holding Bitcoin is not about competing with bonds, but about fully exiting that system. But the issue lies here. The put-out argument is strongest when the traditional system shows signs of collapse, such as during periods of massive money printing, zero interest rates, and risk spreading everywhere. Whereas right now, that very system is actively offering a very clear bargain: 5 to 6% safe yields. And when the system is still paying out steadily like that, the call to exit it becomes much weaker. That is why Bitcoin is not being sold, because its technology has problems, but because of very practical, very rational reasons, the holding incentive is being eroded. However, this factor alone usually only creates a slow downward trend and can hardly explain a 45% crash in just a few months, and it is precisely here that we begin to sense that it is not merely a lack of buying pressure, but that there exists an active force pushing prices down. If the weakening of the holding incentive is like an oil spill, then spot Bitcoin ETF funds are the spark an entirely new factor. This is something that has never appeared in previous collapse cycles. The crashes of 2018 or 2021, in essence, were still human stories, panic, greed, reversing and cascading leverage liquidations where emotions dominated everything. But this time is different. This time, the market has an additional mechanical factor, and it is precisely this factor that makes the crash dangerous. An ETF on the surface is merely a tool that makes access to Bitcoin easier. But what is both attractive and frightening about ETFs is that they have no belief, no long-term vision, and certainly do not hold to the death. An ETF is a machine, a purely mechanical mechanism that reacts only to capital inflows and outflows. When an investor sells ETF, shares the issuer. Whether BlackRock or Fidelity has no choice, they are forced to sell the corresponding amount of underlying Bitcoin, and from here, an automatic loop is triggered. The price drops a little, a group of investors panic and withdraw from the ETF fund is forced to sell Bitcoin to pay out. That, selling pushes the price down further, and this deeper drop continues to trigger additional rounds of redemptions. In this way, the market falls into a perfect selling loop, almost impossible to stop. The scale of this loop is what is truly frightening. The total assets of Bitcoin ETF funds are around $100 billion. And in a bad market week, if only 10% of investors withdraw equivalent to $10 billion, then ETF funds are forced to sell $10 billion worth of Bitcoin on the market, regardless of the price at that moment, unable to wait for a better price, unable to delay, they must sell. A selling force of $10 billion in 1 week is enough to overwhelm any buying effort, whether from individuals or institutions. This mechanism strongly recalls portfolio insurance strategies that made the 1987 crash far worse when automated models sold more as the market fell, and the very act of hedging became the factor that amplified the disaster. History once again is repeating itself. ETFs have brought Bitcoin into a standardized, mechanized financial arena governed by the cold rules of capital flows. And once it has entered that arena, Bitcoin is no longer valued solely by belief but by mechanism. And along with that come the brutal operating rules of capital flows. The collapse now no longer comes only from humans, but has been automated by machines. Thus we already have two legs of the chair, wobbling a weakening holding incentive and an automated selling mechanism, but there is still the third pillar, the one that for many years has served as a psychological cushion for investors, namely the foundational narrative. And unfortunately, this narrative is also facing serious problems. Throughout 2025, the world went through a series of instabilities, from geopolitics, public debt, to monetary tensions. A backdrop that should have been the perfect stage for Bitcoin to prove its role. But that most important test failed gold. The traditional safe haven asset did exactly what was expected by rising about 65%, and behaving as a store of value during times of instability, while Bitcoin, still called digital gold, plunged, creating a contradiction that is very hard to defend. It is like an athlete expected to win a gold medal, but suffering cramps right from the qualifying round. This is precisely the phenomenon that analysts call narrative erosion, because a big narrative rarely collapses in a single moment, but is usually worn away gradually bit by bit each time it can no longer explain real price behavior. When the narrative and reality no longer align, investors begin to question, and at that very moment, belief is no longer a solid cushion when prices rise. People are willing to believe in almost any narrative. But when prices fall, and especially when they move completely against the narrative that has been told, doubt begins to emerge. So, if the digital gold narrative has weakened, what about other narratives, such as a decentralized financial system or an asset that cannot be controlled by governments? In theory, they still exist. But in investment psychology, narratives do not exist independently, but are closely interconnected. And in the Bitcoin ecosystem, the digital gold narrative has always been the central story. When the central narrative begins to crack, the remaining narratives, even if technically correct, gradually lose their persuasiveness in the eyes of the market. This is the easiest story to understand, and it is also precisely the gateway that brought most institutional capital into Bitcoin. So, when the main narrative begins to wobble, it drags down the credibility of all the surrounding sub-narratives. Investors begin to ask themselves, if Bitcoin is not a safe haven, then is it really the future of finance, or is it ultimately just a speculative asset dependent on liquidity? And at that very moment, Bitcoin is repositioned in investors' minds from an independent safe haven asset. It is increasingly grouped together with high-risk technology assets like a growth stock. This repositioning leads to a very important consequence. Investor tolerance drops sharply. Each new price decline is no longer seen as a buying opportunity, but becomes yet another piece of evidence that the narrative was wrong, and also another reason to sell. This repositioning leads to an important consequence. Investor tolerance drops sharply. But while the market is still grappling with the numbers, a legal black swan has appeared, delivering a fatal blow to the last hopes of those who worship financial freedom. On Friday, February 6, 2026, the People's Bank of China, PBOC, together with 7 other government agencies, including the Ministry of Public Security and strategic regulatory bodies, issued a joint announcement tightening controls over stablecoins and the tokenization of real-world assets (RWA). This is Beijing's most decisive action since 2021, not only limited to the domestic sphere, but also extending its jurisdiction internationally. The new ban directly targets the loopholes that digital stablecoins have created to pierce capital control systems. Accordingly, Beijing bans the issuance of all renminbi-pegged stablecoins, both onshore and offshore, without official approval, while absolutely prohibiting the use of distributed ledger technology to tokenize ownership rights of real assets into digital certificates. More frightening still, this mechanism establishes a web of joint liability. Technology companies, marketing entities, or payment providers will face severe legal consequences if they support these projects, regardless of where they operate in the world. Chinese regulators argue that these assets are essentially a form of currency in disguise, posing a direct threat to national financial sovereignty. However, the deeper objective of the ban is not merely technical, but a direct geopolitical confrontation with the digital dollar. The rise of U.S. dollar-backed stablecoins, supported by the U.S. Genius Act in July 2025, has turned these tokens into cash-equivalent assets. From Beijing's perspective, this represents an existential political threat. If elites and businesses can easily access foreign currency through anonymous wallets beyond the central bank's control, the state's capital management system would be fundamentally eroded. The spread of digital dollars in everyday transactions is not only an economic disruption, but also risks leading to a scenario of dollarization within China itself, undermining confidence in the domestic currency. At this very moment, Bitcoin and the ecosystem around it have been caught between two power pincers, making the dream of a politically neutral safe haven asset more distant than ever. If we synthesize the entire picture, we see the holding incentive disappearing, the automated ETF selling mechanism operating, and the foundational narrative being eroded. These three factors simultaneously point to a core issue of Bitcoin. It generates no cash flow and has no clear valuation anchor. This is Bitcoin's most fundamental characteristic. Not generating cash flow does not mean failure. Gold is the same, but it creates an extremely important consequence. Bitcoin's price is entirely dependent on external factors, specifically expectations about liquidity and the strength of its narrative. And when both of these factors weaken at the same time as we are witnessing extreme volatility, is not abnormal, but rather a pre-programmed outcome. Looking back at history, declines of 70%, even 90% are not exceptions. Volatility seems to be hardwired into Bitcoin's DNA. So the final question is, should we consider this normal and wait for a recovery, like in previous times? This is an extremely important point to clarify, because volatility is not a flaw of the system. It is the price to be paid. Bitcoin rises very fast when favorable factors converge, and it will also fall very fast when those factors reverse. Bitcoin has always risen very quickly during favorable periods, followed by extremely deep corrections. But an important question that needs to be asked is whether the past truly repeats itself. The fact that Bitcoin recovered strongly in previous cycles is not a guarantee that it will certainly happen again, because each cycle carries new factors. And in this cycle, the decisive new factor is precisely the ETF mechanism. In that context, many fears are being discussed in the market, such as the possibility that Michael Saylor's MicroStrategy could be forced to liquidate billions of dollars worth of Bitcoin, or concerns surrounding risks from quantum computers. But these are in fact typical examples of fears that are misplaced. Narrative traps. They are sensational attention grabbing, but they distract us from the core issue. The real risk for MicroStrategy is not an immediate forced sell-off, but rather a scenario in which Bitcoin remains at low price levels for a long period of time, 2 or 3 years, putting the company under pressure to refinance and service its debt. Similarly, quantum computers at present remain only a long-term theoretical risk, rather than an actual short-term threat. These fears are like distant thunder, while we are standing in the middle of a real storm. And that storm is the weakening of the holding incentive mechanized capital flows and an eroding foundational narrative. Therefore, the most important question is, if you are listening and feeling confused, what should you do? Sell everything or buy more? This is not investment advice, but in a structural trap. Like this, a rational approach needs to begin with changing the question. The question should not be, is Bitcoin about to go up or about to go down? But rather, what role should we participate in this game with and at what scale in order to survive? From there, a few basic principles emerge, and the first principle is to allocate only a small proportion of the portfolio, for example around 5%, or at most 10% for those with very high risk tolerance, a number that in the worst case scenario, if it loses most of its value, will not destroy your financial future. Second one must always assume one thing in advance volatility of 50 to 70% is completely normal. And if you cannot withstand that level of heat, then this simply is not a game for you. Third, consider periodic investing, buying small amounts regularly, also known as DCA, because this approach helps remove emotion from investment decisions and reduces the risk of buying at the wrong time. And finally, and most importantly, never bet your entire future on a single narrative. This forces us to reposition the role of Bitcoin. It is not gold, not a safe haven asset, and not a lottery ticket for quick riches. Bitcoin should be viewed as a long-term growth asset, with asymmetric upside meaning. The potential upside is much larger than the downside risk, but only when we allocate a small proportion. It is a very small bet on the future, not a foundation for sustainable wealth. In reality, sustainable wealth is built from far more boring things. Ultimately, the biggest mistake an investor makes does not lie in misjudging Bitcoin's future, but in betting the wrong size on something that inherently cannot be accurately valued. In investing, staying in the game is always more important than trying to be right always, and to stay in the game. What we need to manage is not belief, but the risk structure within our own portfolio. Finally, leave yourself with one question to reflect on. If the ETF mechanism has permanently changed the way Bitcoin collapses, will it also change the way Bitcoin recovers in the future? And if that recovery happens, will it be driven by an entirely new narrative or by a capital flow mechanism that we have not even imagined yet?